Iron Condor. An iron condor is a premium collection strategy where you sell an out of the money call, buy a further out of the money call to protect it, sell an out of the money put, and buy a further out of the money put. Sort of like an option sandwich. You use this type of trade in a range-bound market and you think the market will not move sharply in either direction before expiration. It's a premium collection strategy. You're looking to profit from a flat market. This position is a limited risk short option strangle. Profit potential is limited to the premium collected, the net premium collected. At expiration, if the break-even is equal to the short option strike price plus or minus the net amount collected for the spread. Maximum profit is achieved at expiration if the market is at or between the call and the put strike prices. Those are the short, call, and put. The risk is limited by buying the outside options. Maximum loss is the difference between the short and long options less the premium collected. Maximum loss occurs when the market is at expiration is trading at or below, above the long call or below the long put. Okay, here's an example of an iron condor in the treasury bond market. What we're doing here is we're selling a 114 call. We're selling the 114, buying a 116. On the downside, on the put side, we're selling the 111 put and buying the 109. Now notice, it's important to notice that while we're keeping the options, the distance between our short options on the call and the put side, we're keeping the distance the same. So in other words, we're buying our safety 2 points above our short call, and we're buying our protection on the downside 2 points below our short put. This is called equidistance. Okay, now, getting filled on the trade, you collect a credit of $1,171. Now, the risk on the trade is limited. It's a limited risk trade of 2 full points on both sides of the trade. Okay, you have 2 points here and 2 points there. Now, that's in bonds, that's the equivalent of $2,000. Now, to calculate your risk, you take $2,000 and the amount of money that you risk, and you subtract the amount of money you're collecting, $1,171. So in actuality, this trade only has about an $879 risk. Now, you can only lose on one side of this trade, unless, of course, you break the trade apart and start legging out of it. Okay, so and the maximum that you're going to make on this trade is $1,171. The most you can lose on the trade is the difference between that and $2,000. As you can see, the market going sideways. The strategy is not making money as of yet. This is the type of strategy that you put on and that you just let run. Even if the market goes beyond either the strike prices, it usually pays to see what happens. And as the trade goes on in time, you can see that the market is trading between your two short strike prices, which is, well, the optimal place. Right now the trade is up $440. This is an iron condor.